Welcome, everybody, to Crossing the Line with Greg Heym, where we dig into the latest news on the economy, housing, and whatever else happened last week. Today's February 12th, and it's our Baker's Dozen episode. This is 13 episodes. We're very excited. Thank you for the support. I am the aforementioned Greg Heym. That's why I'm on the show, because it's in the title. Thank you. Chief economist of Brown Harris Stevens and author of The Line, as opposed to Another Line, weekly economics blog with over 2,500 satisfied subscribers. We're a little below the McDonald's threshold of how many hamburgers, but we're working on that. A special welcome to any new listeners out there. Well, great to have you. Please make sure to subscribe to this and all the great podcasts on the More Network. Great, diverse group of hosts and subjects. Today, we have Ray and Lena, as always, hiding in the background. Lena's taking a picture of me, get my good side. But we have a special guest, and we love special guests. My good buddy, Michael Vargas, founder, principal of the Vanderbilt Appraisal Company.
Hello, hello.
And, it's funny, you and your old partner, Drew Foley, are the reason I'm at Brown Harris Stevens.
That's right. I take all the blame
for
recommending that you get hired.
Well, it was an idea to build a research department for Terra Holdings, the parent company of Halstead, which is now part of Brown Harris Stevens and BHS. And I've worked closely with you for over 20 years. And always liked you more than Drew anyway. But most people would probably say that too.
I have a question for you. First of all, congratulations on episode 13, you said?
That's right, yes.
All right. So episode 13, day after the Super Bowl. How many episodes in do you think it will be before you and I sit here the day after the Super Bowl and your Jets and my Giants are playing?
Well, this is ironic too, because the game-winning catch was caught by McCall Hartman, right? Who was a Jet at the beginning of the year, and we didn't need that guy, so we cut him, and he had a rough year. It's kind of nice for him that he made the big catch at the end. But, the Jets last won the Super Bowl in 1969, otherwise known as a year before I was born, and have not been back since.
I'm going to go with episode 50,562.
I'll be dead. Instead of a Ron Guidry bobblehead, maybe we'll have a Greg Heym bobblehead. He'll be hosted by Greg Heym the 6th or something like that. I don't know. My son's going to do that. But it was a very hard to watch first half of the Super Bowl, but a great second half and over. I don't like the overtime rules. This upsets me. I think either play a full quarter and that's it, or just keep the game going without a clock until somebody scores. Just continue where you leave off in the end of the fourth quarter. Encourage teams to go for the win at the end. It's like watching college football where they line up at 1 yard line and then they go back, and it's insane. I don't like it.
I agree.
Well, and Mahomes is looking like the man. What can you say?
He's hard to beat.
As my son would say, he's him, as the kids like to say.
He's hard to beat, but I love the fact that the last play of the game, the last play of the season, that you, as a staunch Jets fan, had to hear about your ex-Jet player winning the game.
Well, the only thing that would have been worse...
Just classic Jet pain.
The only thing that would have been worse was if Sam Darnold had to come in or leave Brock Purdy, and he said the Jets would regret letting him go, and we regret so many things it's hard to keep track of. As always, we're in beautiful Studio 1873 with this great decor, thanks to our friends at the Everset. Thank you for the furniture, and we'll be having new looks from time to time, so hopefully you'll love them all. As always, trying to be informative, concise, entertaining, and edgy all at the same time, at no extra cost to you. And as always, we'd love to hear some feedback. You can reach us at ctl@bhsusa.com. Just a programming note before we start. We're going to be off next week because it's President's Day. See, I'm so smart, Ray, that I insist on filming Mondays because that's when you have the most holidays. So I get the most days off. It's also my birthday next week, so I'm not going to be doing hopefully too much of anything. So we will have the blog will come out on Friday, and then I'm pretty much done with work for almost a week after that. So that's our intro. Welcome as always. It's great to be here, and it's great to have Michael here.
Yes, it is.
Yes, you've told me that time and time again that it's. If you read the blog, and it's not too late to go read it, we have our line items every week, which is what was in the line, and we joked in the column that it was a really, as my son would say, midweek for economic and housing news. There wasn't anything too exciting. This week, there will be some exciting news. We have, as we like to call them, the PI brothers, the CPI and PPI, and retail sales come out this week. Again, sorry we won't have a podcast on that, but you'll be able to read all about it in the blog. So without a lot of headlines, we kind of did some quick hits, so I'm just going to run through some of that stuff quickly. So you get a feel for what you may have missed last week as you were ramping up for a Super Bowl that fortunately lived up to the hype. I tell my son when I was his age, he's 16, the Super Bowls were blowouts every year. Every year the NFC just destroyed the AFC. It was tough to watch at times, especially since my Jets were never in it. But anyhow, the first bit of economics news that was pretty good news is the services sector grew faster than expected in January. So what does that mean? Well, services make up 75% of our economy. We don't manufacture a lot here anymore. So we certainly look at that as a good sign that the economy is still growing and we can expect to avoid a recession. Looks like that soft landing is actually falling into place. Initial claims for unemployment fell by 9,000 to 218,000. That's very low. Every day I get a whole bunch of articles about how there's millions of layoffs and everybody is losing their job. And no doubt people are losing jobs. That always happens. But it continues not to show up, in this data. And there's a couple of reasons for that. Maybe they're finding other jobs very quickly. Maybe they're getting generous severance packages. Maybe some are choosing to retire. But obviously there's always some industries that are struggling. A lot of tech layoffs have been announced recently. But so far, it's not showing up in the initial filings. So we'll keep an eye on that. But right now, it's still looking pretty good. On a not so exciting note is this thing of credit card debt. We talk about how is the economy still growing when all the excess savings during COVID is used up. We have record high credit card debt, which rose 5% in the fourth quarter to $1.13 trillion, courtesy of the Fed Bank of New York. Since it bottomed, or hit a recent bottom of just $770 billion in the first quarter of 21, it's up 47%. That's how people have been paying for things. Record high credit card debt at record high rates means a 50% increase in delinquencies this past year. So that is concerning, what that will mean going forward. Obviously, student loan payments restarted at the end of last year, so that's more debt that people have to worry about. So the big question is, how can consumer spending, which is about 2/3 to 70% of GDP, keep going at the pace it has when people have all this debt? And obviously, anything that you borrowed for, whether it's a car or a home, you're paying much more than you used to in terms of interest rates. So let's get to housing news. And Michael, please jump in. I have a question for you on this first thing. So at the end of October, we hit a 23-year high in rates. Then rates fell by 1.18% the last 2 months of the year. Since then, it's been in this narrow range of 6.6 to 6.69, up and down. They ticked up last week. We know the reason the rates have stopped falling is because we keep getting all this better than expected economics data, right? Everything's, whether it's employment, GDP, retail sales, everything is coming up. Even inflation data was a little bit higher than we wanted. How are you guys doing in the refi market? Did you see a boost at the end of the year? Is there still activity? Because for the longest time it was terrible, right?
Yeah, it's still terrible. It's still terrible. Nobody really wants to refinance. I think more than 80% of mortgages are people hold the mortgage with 5% or less interest rate. So I don't see much of any refi business in the short term, and there certainly wasn't an uptick with rates just coming down a point. It's just not enough to kind of trigger the refinance event. Most of, technically it's a refi as well, but most of what we saw that were non-purchase transactions had to do with HELOCs. So people were taking out some equity and some line of credits at those high rates. So usually that's going to be for a specific reason, for a purchase or for an upgrade,
renovation, stuff like that.
Renovation, or pay off other debt, or pay for your kid's college. But the underlying mortgages that many people have, in the 3s and the 4s, certainly no one's going to be refinancing.
They're holding on to that. It's funny because I get letters from my lender, and you have to feel sorry for them almost, because and like you said, unless you need the money. I do think, the Fed is come out and basically said, we don't want to hear about rate cuts this year. And again, we remind everybody there's no direct correlation to what the Fed does in mortgage rates. They could cut short-term rates back to zero. That doesn't mean mortgage rates would even come down. In fact, the opposite could happen.
Yeah, and I think, as you mentioned, getting lower mortgage rates, it almost, we almost need a recession for that, which nobody really wants. But so really the new normal is, if we have this kind of, fairly strong economy, that mortgage rates are not going to significantly dip down in that kind of environment.
Right.
So the new normal is 6.5 plus or minus a few
But we
percent
always
points.
say that housing prices don't come down noticeably unless you have a recession. Mortgage rates are the same thing, because they're coming down because people are pessimistic about the future of the economy. I think in the second half of the year we'll see mortgage rates really start to come down, because the consumer is running out of gas. That doesn't necessarily mean a recession. And again, the reason why a lot of economists like myself were predicting recession is because the Fed's basically never, or almost never, engineered this soft landing, where they bring up rates enough to stop inflation but don't push it too far. We saw this in the 80s, where Paul Volcker had no choice. He basically had to do it. So then this was interesting, just for the headline. The National Association of Realtors, in their fourth quarter report, noted that home prices are still rising in 85% of cities. Now, we know that home prices are still rising because there is no inventory in most parts of the country. And even with the increase in rates, which again started to fall at the end of the year, but that wouldn't have really affected 23 numbers. But to hear the number 85%, does that surprise you that it's that high?
Well, at this point, it doesn't surprise me. I think, what's transpired since, the spring of 2022, when mortgage rates spiked up, when that began, I thought, well, logically, buyers are going to want to pay less and prices are going to have to come down.
But sellers had different ideas.
Yes, and the sellers had a different idea. So it was, I spent basically 2022 realizing that, my initial logic was not going to follow. And then 2023, we just saw more of the same, that, despite rates being higher and buyers wanting to pay less, sellers were, not flooding the markets with inventory. And so in most of those, markets, 85% of these markets, and almost all the markets that we cover, in the suburbs in particular, we saw, that same kind of phenomenon, is that the buyers are facing high rates, but sellers aren't moving. Right. And so you have, limited supply for sufficient demand is going to push up prices.
Right. And the interesting thing in this report, too, is that 8 of the 10 highest priced markets in America are all in California. And it's funny, the 2 that are not, one is what they call urban Honolulu. I've never been to Honolulu, so I don't know the difference between urban and rural Honolulu, but and Boulder, Colorado. But outside of that, the other 8 are all in California. So I guess when you have perfect weather pretty much most of the time, although San Francisco was 3, but they have a good feed of buyers from Silicon Valley and all.
So that was 8 of the 10 markets that are performing the best?
That have the highest median prices are in California. Prices, yeah. So, well, that was it for the line items. We're going to talk to Michael about the latest in so many of the markets out there that he deals in. But as we mentioned last week, fortunately, we have to take a break for a message from our sponsors, the Everset.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal. And
we're back. Now for the lineup where we grill our guest. Since we have one of the best appraisers around, and a very interesting best guy. He's told me that time and time again. That he's the best.
Wait a second. Did you say one of the best?
Nah, you're the best. What can I say? We've done so many speaking engagements and teaching that I got a good feel for you. You pretty much know what you're doing. You're good. So why don't we get some quick updates on some of the important housing markets, also known as where Brown Harris Stevens does the majority of its business.
That's right.
We'll start here in New York City. Now, this is a little different than the other areas we're in because we have this thing called supply, which has kind of made things different. But what have you seen, and is it surprising you?
Well, in Manhattan, we'll start with Manhattan. As I mentioned, I was surprised that higher mortgage rates weren't leading to
lower prices,
10, 15, 20% decline in prices. You mentioned inventory. What do we have? 7,000 or so listings, which is, sounds like a lot of listings, but for Manhattan, it's not.
It's not. I mean, the overall number is still sort of in that neutral range in terms of the month's supply, depending on the size, of course. But even the super luxury apartments are selling. It's not like these things are languishing.
Yeah, exactly. So, I mean, there's like 1,000 different markets within Manhattan. So it's kind of hard to generalize. But, since we're here the day after Super Bowl, I'm going to use a football metaphor. The Manhattan market, to me, for the last year or two, has just been kind of fumbling around. When someone fumbles the ball on your Jets.
Yeah, we saw it a couple of times last night, too.
Yeah, and the ball goes left, it goes right, it goes up, it goes down. It doesn't really have a clear direction. That's kind of, the Manhattan market for me in the last 2 years.
Well, we
been strong.
Yeah, we joke about this because, so you have COVID, right, and we have to shut down for a couple of months, which really slows things down in New York City. Prices really don't go down that much. They kind of stay where they are. Then the gates get opened. And the outer boroughs were already doing well before we started to see this in Manhattan. We see contract activity like we've never seen before. The prices don't go up. Then we see, like you said, the rates ultimately hit a 23-year high, and the prices don't really change. Now, are they just not getting to that equilibrium point?
Yeah, I mean, I think, there's certainly some parts of the market that have outperformed and are doing well, and then there's a good chunk of the market that's just stagnant. That's just, not really influenced by things that you would think would be, an influence.
And what are those markets that are fumbling more than others, that are not recovering their own fumbles?
Right. I would say well, again, we're talking about Manhattan specifically because I think that the rest of New York City, Queens and Brooklyn and the Bronx are, have been faring well since COVID, and continued to do so. Co-ops, older co-ops that need renovation, those are, certainly languishing the market, and a lot of the value and the cost of a renovation today has kind of eroded all of the appreciation that a co-op may have had over the last 10 years. And that's kind of the first time that's happened since I've been doing appraisals for 30 years. And every 10 years since I started, values kind of doubled or, rose significantly. And over this last 10-year period, we're seeing that, if you bought a co-op in 2014 and you're trying to sell it today, you're not likely to, be able to get the same price unless you renovated it last year.
So that's really the value play for a buyer out there.
Yeah, I think, I think that the values are going to continue to go down though, until we see a lower cost of renovation. So maybe with inflation not going up as much, we haven't seen disinflation yet, where prices are coming down.
But
so
that's deflation. Disinflation is when the rate slows.
Oh, right.
We went over this in
Deflation,
the RE.
right.
No, it's only economists. We make up these words just to see if anybody's paying attention. Hyperinflation, cost push,
the bottom line is the
pull.
cost of renovation is still high. Nobody wants to do the work. So co-ops are languishing. That's probably the weakest sector of the market. And then, we still see high-end condos. We still see, ultra luxury doing well, but not in all segments. If you bought at 157 West 57th Street a condo, the first much celebrated Billionaires Row building, you can't sell that for what you bought it for today. But downtown, in all of the
prices downtown, the resales,
and all of the ultra luxury condos downtown, those are doing well. You could probably get 5 or 10% more than you paid for.
What about townhouses? Because to me, I always remind people there's only a couple thousand of those in Manhattan, so it's hard to gauge value. But they has this boom in super luxury development, all that space and amenities available. Has that really hurt the townhouse market, or did COVID kind of mitigate that for people that wanted isolation and multi-floor living?
Well, the thought during COVID that people were going to gravitate to townhouses and have space to themselves and a lot of space and extra space for home offices and Zoom class and outdoor space, that townhouses were going to offer everyone what they wanted after COVID. I think that was short-lived. I think maybe there was kind of an initial, gravitation of demand that way, but I don't think it lasted long.
Did those buyers, a lot of them seem to, maybe they went to Brooklyn or Queens, although, some of these areas really don't have a lot. In Brooklyn Heights, very small number.
Very small number. But again, I think the townhouses have suffered because of the cost of renovation. Okay. Is that it's hard to keep up with value. It's hard for a seller to have an expectation of a price when the buyer's coming in and saying, I have to pay $3 million to renovate this. And then when they start factoring in the sale price plus the cost of renovation, it's better to go find something else to buy.
So one of the things that we noticed when we did the fourth quarter reports was a big decline year over year in sales. Again, I don't think that says much about demand other than things were a lot better a year ago. Rates were lower. I think the climb in rates during 23 really slowed down activity in the second half. Mm-hmm. All right, so moving on to some of the other areas, Connecticut, Fairfield County in particular, we joke that you can actually name all the listings in some of these towns. They're not big towns to begin with, but what are you seeing there? Is inventory still so low that you expect that's one of those areas where you expect prices to continue to rise this year?
Yes. I think in not just Fairfield County, Connecticut, but a lot of the suburbs that are around our markets here, Westchester, in New Jersey, Bergen County, Essex County, all of these areas where people work in Manhattan and commuted 5 days a week and then had a house out in the suburbs. Now people are commuting less or not coming to work or maybe coming into the office 1 day a week. So the thought of, somebody who thought, well, maybe I'll stay in Manhattan because, I don't want to commute. I don't want to be on a train 5 days a week. They're not facing that anymore. If they're only coming in once or twice, they're happy to be in the suburbs with more space. And so in all of these markets and most of these Connecticut markets, we've seen 20 or 30% lower sales volume because there's the demand is not there, but just because the listings are not there.
Right, and certainly for areas with luxury homes, like all the areas we do business in, when you have the S&P 500 setting new records all the time and this renewed optimism that the economy isn't going into recession, and we'll have rate cuts to look forward to in the second half. The money's out there, right?
The money's out there. The wealth is out there. The outlook about the economy is, good enough. And, we're not seeing, although, you do hear about some layoffs here and there, but we're not seeing, we're not seeing an economic, crisis or crash.
That's good. I'm tired of those.
Yes,
we can move on from those.
Right. So there's money out there. There's wealth out there. There's a tremendous transfer of wealth going from, grandparents and parents to the next generation. And so there's just enough demand out there that the listings and the inventory can't keep up. And so, most of the agents, if they're lucky to have a listing and it gets sold quickly, they're like, if I had 10 more of these, I could sell them, right away.
Right.
And that kind of pervasive and, consistent low inventory environment has, it's really persisted since the, surge of demand away from urban dwellings to the suburbs during COVID.
Now,
after COVID.
This is similar too with what we've seen in New Jersey. Similar to activity. I mean, there too, you've always had areas like Hoboken and Jersey City that have always been tight inventory wise, right?
Yeah, it's nothing new, for there to be tight inventory in Hoboken. It's such a small market,
Right.
and Jersey City as well. But, the price increases in those markets, all of them are at record levels pretty much from, if you compare from 2018, 2019, pre-COVID. So prices continue to rise. I think last year was a slower, pace of increase for, so I think in those markets.
That's disinflation.
Right. So I think in those markets, actually, the higher mortgage rates led buyers to pause for a bit,
Right.
and then maybe not, want to be as competitive in terms of how much they were bidding. So, values were still up 5 or 7%, or the average price year over year was still up 5 or 7% as opposed to 10%, because inventory is low enough that you should see almost double-digit increases.
Yeah, I think people get scared like when they hear some of this stuff, but it's markets behaving like they're supposed to behave.
Yeah.
Except for the whole mortgage rates shooting up and prices still going up. That's something we have to get used to. But all right, finally, let's talk about Florida a little bit. Palm Beach, we always used to joke that there are more realtors than homes in Palm Beach,
Right.
and that leads to some very impressive sales. And with Palm Beach, that obviously, maybe you go back to tax reform, may have led some people to go, and then COVID may have pushed some more people out there. But Palm Beach still humming along pretty good.
I mean, Palm Beach is a crazy market. It's it's such a small market. You probably have 10 buyers for every possible listing that might be out there. But then you're also talking about a very, very high end of a market where the average usually the average sale price is somewhere between 10 and 15 million,
Right.
for 18 houses that sell in
In the estate
year.
section,
Right. So, that market has been strong and steady since since COVID, and really hasn't let up. I mean, some quarters you'll see the numbers drop, only because the prior quarter there was a larger handful of big
right. When you have that
sales.
small of a
Yeah.
sample, the data can be up and
Yeah.
down just because of
So
one.
sales. Some periods we see 16 sales for a quarter, with an average of 10 or somewhere between 10 and 15 million. So,
Now Miami, still seeing the same level of interest.
yeah, I think so. I mean, I think that Miami condos and the single family market there, we saw more of the same there. Low inventory and still sufficient demand, despite the fact that rates are higher. That's a pretty big all cash market. So that didn't really, the rates are going to have some impact.
And heavily investor, right?
Yeah.
Is that still?
So, but we didn't see. I don't think there were double-digit increases in prices, but 3 to 5% growth, quarter to quarter or year over year. So the growth of prices is mitigated somewhat, but it's still, a market like all the others, which is very low inventory and still enough people out there looking.
So speaking of Florida, the most expensive home for sale in the U.S. right now is in Naples for just $295 million. Now, there's been a bunch of homes that have been priced even higher than this, but they always sell at extreme discounts or don't sell. This is sort of a unique kind of, case where somebody just bought up all the houses in that area and made this huge house. I guess my question here is, when you get a sale like this or the Ken Griffin sale or whatever it is, how do you go about appraising it when you have to try to value something that there are no comps for?
Well,
because that's something that happens at every price point. In certain, what do you do when there's no reference point?
Right. Well, from an appraisal standpoint, there should be a rationale for value of some kind. I'm not saying that 295 is worth, that property is worth 295, but there should be some logical and reasonable rationale for getting to the appraisal value for that particular property. It's oceanfront. The measure of value is not going to be comparable sales, right? Just straight comparison of one house and its sale price. But for a waterfront property like that, we would probably do a price measure on a per linear foot of water frontage. And so if you strip down that sale price of 295 million, and I think the article says it has 1,650 feet of linear water frontage. Since you're an economist, can you tell me what that comes out to?
No, and as I point out, economists don't do math. The computers do the math. I sit here, look good, and explain things, and I try to use small words.
Well, listen, comes out to, I think it comes out to like $180,000 per linear water foot. And so when you strip it down on the basis of, water frontage, then, you can kind of look at that measure of value and see how it compares to others.
Okay, well, because I remember
in the Hamptons, for example, you can have a sale that is like $300,000 per linear foot.
Wow.
Or even $500,000.
Because this is Naples, not Palm Beach, too. It might be a little bit easier, right, if it was Palm Beach. All right, so to keep it moving, this is something that one of our sales director's sons is, I won't name names, is studying economics, thinking about grad school, and asked me this question. As you know, congestion pricing is finally maybe going to happen towards the end of June. And for those of you who don't know specifics, here's kind of what we know so far. There's basically going to be a $15 toll for most cars to drive south of 60th Street, which could raise $1 billion a year, according to the MTA, which they're going to use to make the subways and commuter railroads and buses better. Let's hope. It's the first time this has been done anywhere, and obviously there's a ton of lawsuits, most notably one from New Jersey and the teachers union. How does that affect value? Now, for me, it's hard because you're looking more about valuing individual property. From a market standpoint, I can't look at 60th Street as like this dividing line, and because there aren't enough sales to do that. But from a logical standpoint, you'd expect fewer cars driving on these roads, potentially more people taking mass transit, which could be good, but then it could make the cost of goods more expensive and cause some local shops to close. So I don't know. Have you given this any thought? Do you have any opinion on, is it just a zero-sum game where you don't really think there are bigger forces that are going to drive value than this?
I think from a housing and a value standpoint, I don't think it's going to be a big, it's going to have any impact, either positive or negative, because I don't think it's going to work. The whole plan that the government put in place, thinking that they're going to raise $1 billion and that $1 billion is going to go to improving mass transit, it's really unlikely to work. These things tend to have like unintended consequences.
And the city has like no control over this.
Yes,
Like
so,
obviously that's also disconcerting.
Let's say for example that you did raise $1 billion and all of a sudden we had this amazing transit system that got people from the suburbs to want to come back to the city and say, oh, everything is so much greater now. Commuting, we have this. That's not going to happen. The money's probably going to get wasted. There's going to be unintended consequences. And
kind of like how all the lottery money is supposed to make schools so great, right?
Yes.
Or
there's a reason why people, call the MTA the money-taking agency.
I've been taking my money for 32.
It's a money grab, and we'll see, how much money it ends up raising. But, from a housing standpoint, I'm thinking that if the goal is to reduce traffic below 60th Street, and so all of a sudden now you have a lot of, you have less traffic in Midtown, for example, and then people who were looking for property in Midtown started thinking, oh, wow, it's not so bad here. There's not so much traffic. It seems more residential. You could think about a scenario where, the area, that central business district gets, less dense, less traffic-y, and people think, all right, I could live here, as opposed to having to, as opposed to going to the Upper West Side or Upper East Side. But I don't think that's going to happen. I think, as you said, the people who have to drive below 60th Street and drive around the city are going to pay, they're going to pay the price, and then they're going to pass it off.
Isn't that what to their customers? And it's just like, Con Ed gets their property tax bills higher, they pass it on to their customers.
Yeah, for example, I drive around the city all the time, and I'm going to have to pass that $15 on to my appraisal.
Stop polluting the environment, Vargas, and get on that. All right, the final thing here, and this is one of the, I sound nerdy if I say it gets me excited, but the New York City Housing and Vacancy Survey, which is supposed to be done every 3 years. COVID kind of threw that for a little bit of a loop. So I think it's been 2 years since the last one came out, the initial findings. And I mean, I could spend several of these shows going over the more interesting findings, but there are 3.7 million housing units in New York City. 2.4 million of those are rentals. It sounds like a lot, right? The problem is that 1 million of those are rent stabilized, about 41%. So this leads to a 1.4% rental vacancy rate. Now, that the whole idea of rent stabilization is put in place based on the vacancy rate being at a low level. If it crosses, I think, the 5% mark, then rent stabilization is supposed to go bye-bye. But, what a shock it hasn't. This is the lowest vacancy rate since 1968. And just 2 years ago, it was 4.5%. So with all the, rents went up significantly, and they're still pretty high, it shows the problem that we all know, that we don't have enough housing here for, the 8.5 million or so people.
More people than we have units.
Right. We have mass transit, we have jobs, but we lack housing. Now, I guess one of the problems has been that the incentives that were given have most of them have disappeared, most notably 421A, 421G in Lower Manhattan. You're not going to get a significant uptick in development without tax incentives, right? I mean, so one of the things that has come up is we have these office buildings that are sitting empty. And this is what started the Lower Manhattan Plan 30 years ago. Let's convert these old buildings to residential. They'll go from being old, out-of-date office buildings to chic, retro downtown pads, and it worked great. Do you have any answers to this question? Like, how do we get more housing here? Because anything the city wants to do has got to go through Albany. Yeah. And they don't seem to be inclined to want to do any of this stuff.
Well, this is not just a recent problem, although that vacancy rate, below 2% is just kind of astounding statistic. But the main problem has always been zoning.
Well, now the mayor, in his press release on this, he basically said, they have to work with Albany more to build more homes. And his whole idea of the city of yes, that's his new thing, right? Because zoning is the one thing they do control, and it's free to make a zoning change.
Yeah. And I think, I remember back to the time when Bloomberg was in charge of the city. And there was just kind of a overall pro-business climate. And part of that pro-business climate was being, pro-developer, which is that it's okay to let a developer make a buck. It's okay for them to make a profit without needing to demonize them. And I think what we have to get back to, that's one element of it, is that, yes, we need affordable housing. We need all types of units all across the board. And, from a city and a government side, you need to be more pro-developer, more pro-private business, and that it's okay for them to make a profit if, hundreds are needed in the city.
And the with
jobs
those
that
units,
come with it. But I think, there's around, at a city council, and the guy has made enough money and made too much money.
They're always landlords.
Yes, exactly.
And you see what's, and the fact that you can't destabilize has done to the value of some of these buildings.
Many of them are just small businesses, really, owning and managing these businesses. So if you take, it doesn't mean you have to go totally pro-developer and approve, ultra, more of a, centrist position. All right, let's bring all participants involved to create these units that we need. So aside from, being more pro-developer, it's a zoning issue. It's always going to be a zoning.
You try to make zoning changes.
Yes,
boards.
Yes, right. So you go back to the city has to go to the state, change the FAR caps, for example. Your FAR, your ratio is a 5, but if you can make it a 10, all of a sudden you have 300 new units built. But to get them to change, the FAR caps. And then zoning, for example, everybody loves their, beautiful side streets with buildings that are no taller than 5 or 6 stories, but that limits the amount of units. Limits the amount of units.
We're a vertical city, right? We have to embrace that.
If you go to any other vertical city, like, Tokyo looks, they don't have the same type of housing issue because they built as high as they needed to build. So in this, and I think, I'm excited to see what is in this City of Yes initiative, because, the way Adams is talking about it is that if we just build a little more housing in every neighborhood, just a little more, like,
right.
So what he seems to be asking is for variances, for example, where, if you're capped at 5 stories, can we make it 8 stories so that it adds just a little more housing?
Right.
But the riddle is all about zoning. It's about what's allowed
and
to be
they've been
used.
flexible right in this area with the Midtown East office building rezoning. They let them rebuild buildings higher than the current zoning rules would allow.
Yeah.
Just for the
and
incentives.
I think that rezoning, plan was, I don't know, took 15 years maybe.
The zoning takes so long. But this is why I love property taxes, but I will not touch zoning. Well, we've run a little long, but it's always great to be with my good buddy, Michael Vargas. Thank you so much.
What? That's it?
As George Thorogood would say, the clock on the wall says 3 o'clock. Actually, the clock says 43 minutes. So we've gone over a little bit, but thank you for sticking it out with us. And remember, we'll be off next week for the Greg Heym birthday holiday race, so you don't have to come in on Monday. I'm giving you that dispensation. Thanks again to Michael. And thanks again for tuning in and supporting the show. Thanks to the Everset for this beautiful set. And remember to like and subscribe all the great podcasts on the More Network.